usually it's going to be like a change of ownership, and so many of these assets are handed down, and the children may or may not follow in the parents' footsteps, but they're dumped in their lap. Those are the distressed situations that I really like.
Grant, welcome to the show today.
Thanks, Garrett. Glad y'all had me on.
Now, you're in the oil and gas industry.
Correct.
Talk to me a little bit about how you get involved into the game and what you're doing now.
So me getting involved kind of started as a teenager, growing up kind of around it. And then, in college, I was actually going to school for political science and had the opportunity to get under the wing of a gentleman who'd been in the industry for a long time. Kind of work my way through various apprenticeships, if you will. They weren't technically that, but sometimes it was paid, sometimes it was unpaid. And then I started investing myself in various projects that other people generated until I was kind of financially sound enough to generate them myself. And then as capital intensive as it is, which you probably know from real estate, it's better to aggregate funds if you really want to grow. So one thing led to another and a few successful ventures. And now we're actually a pretty thriving company, and we've got a lot in store this year.
That's awesome. So, all right. So you started working for somebody initially to learn the business, because I had a similar experience with that. And how long did you work with that person?
So the first one was 3 years. I had another 2-year stint with a different gentleman. And then all up until the end of this past year, I had another 3-year stint. So they were all different facets of the industry. So you pick up a little bit from one person, and then you decide, hey, I kind of really want to be more on this side. And then, if you jump around again, you're pretty much covering all bases. So I really started with land and title, which is like the first step of the process to, drilling or developing a field, is to actually acquire the leases. So from there, I got into acquisitions and then into operations. So I kind of have a bit of a background in all three, which helps me because, one person can't dare do it all. But you can speak the same language as the people you hire or contract to do some of these jobs. So you don't have to, I guess, rely on them 100% when you're looking at their work. You kind of know whether or not it's being done right, which gives you an advantage over others. So many people are one-dimensional that take these executive roles that, I think that parts of it could be lacking just because they're inexperienced. So I might not be a master of anything, but I've got a good framework for all facets that go into operations.
Sure. So I'm looking at this kind of like how, I look at a syndication, but 30,000 foot view, what is your business and what does it do?
So what we do is we try to find opportunities on two different levels. One's going to be either distressed sellers or distressed assets that need capital infusion. The other one's going to be starting from square one. And
what are assets exactly?
That'd be producing wells, cash flow generating, producing wells.
Got it.
Or leases that have the potential to produce. So more on the producing field side. So you might buy a field that's been producing for, I don't know, some of them 2 or 3 years, some of them 20, 30 years. And you're looking for ways to improve that production or drill additional wells, where they haven't, or where they have locations left. So you might have a field that covers thousands of acres, and the original development plan was to drill a well every 200 acres. Well, you've got 30 wells there and 30 to go. And for whatever reason, maybe a crash in the market or whatever, the remaining locations didn't get drilled. So we see that as a great opportunity because you're not paying for those extra locations that have that great upside. You're just paying for what's there. So you're actually kind of getting those locations for free. And there lies your upside.
So, all right. So you get similar this, and guys, there's so many similarities to our business as this, but essentially you're finding, these distressed assets and then you're capitalizing on it. Similar to what we do. We find apartment complexes that are underperforming. We make an offer on it, or in some cases develop a building on a piece of land after purchasing it. And then we implement our business plan to make it more valuable. And so it sounds like you're doing similar things. What would cause an oil asset to become distressed?
Usually it's going to be like a change of ownership. And so many of these assets are handed down. And the children may or may not follow in the parents' footsteps, but they're dumped in their lap. Those are the distressed situations that I really like. They don't have the expertise. They weren't kind of there. So what ends up happening is they try to keep the farm going, and they don't do so well with it. So they wind up contracting help. The help sees a good opportunity to make a lot of money and do as little as possible. And the story never changes, just the names. But let's call it 2 sons and a daughter inherit an oil field. That oil field's making 150 barrels a day when they get it. 6 months into it, it's down to 70. They're spending every dollar they have trying to get it to go back up, and therefore they bleed themselves out, and they're going, okay, well, what can we get for this thing? So we come in, we make an offer, we get it, like within a matter of weeks, we get it right back to where it was, and then it start our improvement. Because it's just such minor changes, but I don't know. I've got a lot of goodwill, but not enough to kind of do it for them and hand it back and pay it premium.
There's not like a LoopNet or like CoStar or something.
There is. But then you're going to be paying 4 or 5 years net cash flow multiple on things. When if you just really get in the trenches and seek out these opportunities, you're paying 2 to 3 years multiple on something that's underperforming.
Right.
You want to pay 4 or 5 years for something that can't be improved on, or 2 to 3 years that's running at 30 to 50% of its potential.
So so it sounds like you guys are hunting for off-market oil deals most of the time.
Correct.
Do you have like a whole setup or team that just calls these people, or how do you find them?
In a way, I guess. We do all of our own work, so we're always out in the field with various specialty vendors. So we contract the equipment, we contract the labor, but it's our engineers. They're turning the wrenches, we're telling them how far to turn, but they're also doing this for other people. So you kind of just hear through the grapevine. We've tried just doing mailers, calling, working with advisors, and you get the same result: overpriced stuff that has very little upside. Some of the best deals comes from, hey, you're just out checking on your well, because what I do is I go across all 5 states that we have wells in once a month, and you'll be out there with the field foreman, and somebody will drive by and say, hey, we got the stuff across the street. We've got X, Y, and Z going on with it, and we just really don't know how to fix it. We've kind of given up. So if since we figured you might be interested because you're right next door, and you're sitting there going, well, let me think about it. But in your mind, you're going, thank God. I don't know what I did. I don't know what I did this week to deserve that good fortune. But yes, I'm very interested.
Yeah, but that seems like you're kind of just kind of like finding $1 at a gas station on the ground or something. I mean, like,
that's the best way to find those dollars.
Really? So, all right.
Yeah.
So you go check on your own wells, and someone approaches you and they're like, hey, I got this field. I'm not running very well.
Man, yes.
That's literally it, huh?
Yeah, because you said LoopNet. Just get on energynet.com right now, look at some of those prices. And if it's under a 4 or 5 year cash flow multiple, it's going to say reserve not met. You're going to get in there and they're going to try to talk you into buying it for the reserve or higher.
So they got a broker involved, and the broker is like trying to drive the price up and all that. So they get a bigger commission.
Yeah. So, that's just not how money is made. But hey, you could get on there right now. You could find there's a bunch of different oil and gas management companies. Pay them $1,000 per well, and you can do this without me. But if you want to find the deals and see your money back in a year or two, you gotta get in the trenches. That's where they hide.
So you guys kind of self-manage everything as well, right? So you're vertically integrated, but are there also there's management companies that just do this for a fee versus
They
owning it?
do. Yeah, they do it. They do it for a fee. But the fee, I guess, is cheap on one hand. It's interest out of line on the other. So, with me, my interest is your interest. If I win, you win, I win kind of thing. So, where they're charging $1,000 a well, that could sound really cheap if it's a high volume well. That could sound really expensive if it's a low volume well. But then anything beyond just sending you the reports of what it's doing is additional money. So when you add it all up, we're probably a lot cheaper and have your best interest in mind.
Man, this is crazy how much it's similar to our industry, which is cool. So like same thing, you can self-manage your assets, your stuff's aligned, you have full integration. I mean, the challenge is the HR side. Now you have to take on all the accounting, all the HR,
That's
but
correct.
it gives you the control that you may want at the time. Now I've done it both ways. We're
Right.
choosing now to do a third party because we have a pretty strong third party management company, and it makes more sense than us to put the infrastructure in place at this level. We just don't really care to deal with that, the other side. But I can see how it would be favorable to have that kind of situation. And would you say most people do that on your side, or would you say it's the opposite?
It's a healthy blend of both.
Mhm.
There,
Yeah.
I mean, with negative interest rates in Europe, there's so much European money in the American oil and gas space. They usually get these contract operators, um, and they're usually the ones buying this overpriced stuff on the internet that keeps the prices so high. But other than that, I'd say it's more geared towards what we're doing. Ever now and then, you'll have a professional of a different industry, whether it be a doctor, lawyer, dentist, you know, baseball player, whatever, that just want to own an oil well, then they'll do it. But for the most part, they're going to manage it themselves. And some of our accounting gets outsourced. Since here's the only thing that's different about oil and gas is we have royalty owners. So with my land background, what I would do is I'd go talk to these farmers and try to secure a lease from them, and you pay them a bonus per acre, and then you pay them a royalty rate out of whatever based on whatever comes out of the ground. What's great when it's just one farmer, but if that farm's been in a family for 10 generations and each generation had 10 kids, you've got thousands of owners. I've got one field in East Texas with 6,000 owners. Now that I outsource, I
Whoa.
don't outsource all the billing and stuff like that. I think it keeps me
A lot of
disciplined.
K1s, man.
Uh, yeah, well, 1099s on the revenue.
Okay.
If it was K1s, I'd probably have more gray hairs and receding hairline and stuff like that. But no, I do all the revenue and all the expenses myself. It kind of keeps me disciplined, because if I'm writing those checks going out for the various expenses, then I'm also going, okay, where are the holes? What can we cut back on? Where can we save? We've done a great job just cutting out expenses. They're kind of another big source of capital is hedge funds and private equity groups and stuff like that. And they'll find a guy like me and pluck me out of my own little thing and say, hey, instead of managing $50 million worth of assets, come manage 300. And we're going to pay you a salary and you're going to get some equity and yada, yada, yada. Okay, cool. Then he outsources everything. And then those costs are way up here, and then they'll ride that cash flow for 5 or 10 years. Then a guy like me will come and buy it, and then, okay, well, I don't need this, I don't need that, I don't need this, and heck, we save a fortune. So there's a bunch of ways of skinning cats, but there's a few tried and true ones, and that's finding these children of oil men that have a little bit of difficulty keeping it going like dad did, and then also these funds that have these 5 and 10-year exit strategies, and then you just walk in and there's nothing wrong. They're performing the way they're supposed to. There might be a little bit more limitation on the upside because they do a lot better than these inherited assets, but there's great upside in cutting expenses out and just a lot of fat that nobody really minded before.
Yeah.
Um,
So I'm curious, how are these structured typically? Do you bring in hedge funds to invest in these, or is it just high net worth
well,
individuals
I'd say,
syndicating it, or?
yeah, so for a long time, it was high net worth individuals. And I'm not saying we don't still, but now we have these real estate syndications that, they're flush with cash. They've taken this great market and liquidated stuff, and they don't like to sit on the cash. And being in Dallas, Texas, I'm not saying it's like a hub for that, but there's quite a bit
It
of it.
is a hub. That's like the mecca of multifamily is Dallas. It's all that we're, it's like the breeding ground for all these groups that, try to produce syndicators on the education side. So yeah, you're kind of like ground zero, man. For
Well,
that
they've
stuff.
done well, and now they're going, what next? So
Sure.
they found their way to me. I've either known them my whole life or known them for a great deal of time. And shoot, I'm on my fourth fund with guys like that. And a lot of times they really want it to resemble the multifamily space.
Sure.
Either the juice is worth the squeeze. We're going to ride it just as it sits and just keep cashing checks, or hey, we're going to lay out a plan to go pursue some of the upside and improve on this cash flow. But I'd say
So,
kind of more the high net worth people, they're taking advantage of the tax benefits.
yeah. So talk about that a little bit. What kind of tax benefits would a passive investor get uh,
well,
getting into one of these?
so the greatest tax benefit is neutrally. So you put 100 grand in, you write 100 grand off. And then on top of that, the cash flow that you get from that 100 grand, you only pay taxes on 85% of it. So 15% is tax free. And what they're letting you do is depreciate that reservoir you're producing from. It's so you're writing off the intangible expenses, which is going to be the man hours, the equipment rentals, anything you can't salvage off of that well, which winds up being 80%. And then you're doing bonus depreciation on the tangible equipment that goes into that new well you're drilling. But the
And
cash
how does
flow,
that go? Because we have still 100 for a couple months, then it goes to 80% bonus depreciation. But what does that look like on an oil and gas field?
it would be the same thing. That Rule 179 qualifies. Now, when some of these things start going down and stuff, you're going to have to start moving closer and closer back to 7 years. So we've had a little bit of a, I guess, compounded benefit than we have in recent years. But even, I mean, since 1986, you've gotten to capture at least 80% of it in the first year, just because that's how much of a new well's cost are intangible things you can't salvage. So you have been getting that for a long time. Recently we've been getting the whole thing. And then, we've always had the depletion allowance where you're depreciating your reservoir. Now
What
that's for the drilling.
what kind of returns do these things spit off typically?
It's so far all over the board, but you go into it knowing what you're trying to accomplish. So, I mean, you can have wells that might take 3 years to return the capital, even though they're brand new, but you have a reason why you're doing it. Maybe they last 100, or you have wells that'll return the capital in 3 to 6 months, but they last 5 years. And then there's everything in between. I like to shoot for things that return between 12 and 18 months, cash on cash, your initial investment, but they have at least 20 years or better of productive lifespan that's profitable.
And is there ability to do like in our business, we can do a refinance and cash out a percentage of initial investor capital? Is there something like that exists in this industry too?
There is. So on the drilling side, I would say if you go into a project that's a multi-well project, absolutely. You're going to have your cash back. from the cash flow. And I think that's the biggest difference between this and real estate, is you're not sitting there just kind of building equity, building, wealth on paper. You're building wealth in your bank account, which has the pros and cons too. Yours is constantly growing. Mine, you get it back in your hand and then you have to do something else with it. So because that well's value is going down as you're making all this cash flow, where yours, you might not be making all this cash flow, but your value's going up. So that's kind of where the disconnect comes.
So the value of these go down as you spit the cash out?
Right.
Oh,
Well, because you write it off the day you buy it. Then
right. But when you go to sell it,
right. Well, you go to sell it, but let's say we drill a well today.
yep.
We spend $1 million on it. It generates us $5 million in cash flow in the first, let's call it 15 years, but the majority of that's probably going to come in the first 36 months. Well, then when you get down to, let's call it that 10th year, you can sell it for a 3 to 4, or if you get on Energy Net, sometimes 5-year net cash flow multiple. That's probably at that point in its life lower than what you put in it. You've
There's
already
less left, right?
Yeah, you've already made your money. Let's say at that point, that well's cash flowing 300 grand a year. You sell it for 900 grand. So you lost 10% on your principal, but you made 500% in cash flow. And it's not like a IRR weird term that, you amplify something that's actually 10% and you're calling it 35, even though you don't have 35% cash in your pocket, So I always stay away from those things and refer to cash on cash, because, when it has these numbers that are referring to a portion of the capital, not the entire pie that you put in, then somebody's going, well, it's not adding up, and you have to sit and explain it to them.
So
only
ideally, to
cash.
break this down, and not to cut you off, but just to break this down.
Yeah.
So you've got a let's say you're launching a new, or you got a deal, you launch it, you're like, okay, we're going to return a capital. I give you 100K, and I'm like, okay, here, put this into the deal. Goes into a fund, maybe with other oil wells or whatever, or maybe it's a one-off. That 100K, you try to return it in 18 months ideally, or 2 years maybe, let's say. And then after that, you're kind of free rolling, right? So
you're free rolling. So you got it back in your hand. Now
that money that I get back, that's all my capital. So obviously I'm not paying taxes on that, but I have a right, I can write off 100% of that 100K, right? Out the gate.
So okay. So the only thing that I want to go over is, you put the 100K in, it goes on your Schedule C, it goes against your ordinary income. So you get your write-off there.
Yep.
Now that cash flow, you're paying taxes on 85% of that cash flow.
Yep.
So kind of you're getting it twice. And then but that 15% that you're saving, you kind of get to write it off twice, because if the thing makes its money back 5 times, 15%, 5 times, you're, not quite there, but close. So you kind of getting to write off your principal twice. Now, kind of what in recent times guys are doing is they're actually leveraging their investments and then writing it off a few more times, which I'm not a tax person, so I don't get into that, but they're telling me how they're doing it, or their accountant's doing it. I'm kind of, interested in learning more. It's also outside of my realm.
Does the depreciation cover the cash flow that you're getting typically? So you're getting paid, you have to pay taxes at 85% of it, not all of it, but
yeah. So if you put in 100 grand, you get back 100 grand. 15% of that you're not paying taxes on.
Correct. But is the depreciation side, does it cover the remaining 85% typically, or no?
It does over time.
Okay.
So it's like, okay, if it makes 100 grand this year, then it's probably gonna make about 80 grand next year, because you have a thing called flush production. So you kind of go, okay, well, I save 15. I say, let's just call it 10. I'm off a little bit. Then next year it makes 70, and then it's going to make 50 for 10 years. So then you're saving 7,500, and you can write off more. You can prove that you're depleting your reservoir at a rate greater than 15%, but then you only get to deplete it down to 100%, where the 15%, if you don't do any more than that, it's into perpetuity.
Got it.
Then what if we
So,
had those 20
so
years?
we're at 100. I get my money back, let's say in 2 years, and then you've got how long before I double that? So I get it back, but then how long before I make another 100K, let's say, typically?
Typically, it would be probably 2.5 that second time, and then
Sure.
3 that third time. And then it kind of goes to where then you'd be seeing it every 5 to 6 years.
And then when you actually sell the asset later down the road, right? How long does that take? Like 10 years or something? 15?
I mean, it all depends on exit strategy. Some of these
Sure.
wells we're wanting to turn as soon as we prove they can produce. So whenever you drill a well on a lease, it's usually not the only well you can drill on that lease. So let's say we get a fair sized lease, and let's call it 1,000 acres, and you can drill a well every 40 acres. So, 1,000 acres, well, every 40, we drill 10. As soon as they're producing, we might be setting it up to turn it over to a private equity group that just wants a predictable drilling program. And you're selling them not only the cash flow, but the upside of those additional locations to develop. And that would be a huge arbitrage, and we've done it before. But at that point, that's not going to be one of those long-term sales, but we know it going into it.
Sure. So
So,
you could do that, or you could just sell the whole thing, what, in like 10, 15 years, if you want,
correct,
at some
correct.
kind of
So,
equity multiple of what's remaining.
of what's remaining,
Got
absolutely
it.
right. So
That's
you
cool.
have the
So,
first one, but you're not upset if you have to do the second.
and do you finance these deals or no?
We do an acquisition, so a lot of the last several minutes have been just on new drilling, but on the acquisitions, we've financed one. A lot of times I prefer to use cash because you do have to hedge when you borrow money, and it does have to be, at least 6-7 million in size. Sometimes we see acquisitions that are 1 or 2 million, and they're so great that we can't pass up on them. But you're not gonna get an acquisition that small financed. It's hard enough to get one 5 or 6 financed. When you're going for 20, 30, 40, 50, the bank wants to work with you.
Yeah.
But I hate the debt service. I hate the cost to hedge. So I
Sure.
try not to do it, but sometimes it makes the most sense, and it's actually the highest return. So
Mhm.
we've done it once, and we'll probably do it again next year with the same fund that we did the first one. So yes, you do that. But one last thing on the taxes, we were talking about, hey, throw 100 grand in, write 100 grand off. A lot of times on these acquisitions, we could pursue an acquisition that's $4 million, and we want to put $1 million into it. Well, then 20% of that is written off that first year. So those don't get as much tax benefits, but everything you do improving it is a write-off, and it's right there first year as well. But
Yeah,
yeah,
that makes sense.
usually finance.
That's really cool, man. So it sounds like, you don't really want to finance these that's not the game plan typically, because you don't need to. If you can just, raise the capital and have a cash flow, that's more ideal. But, because you don't have to worry about debt service, et cetera.
Mhm.
And then let's say you buy it for, $1 million, you have to improve the operations. How much? So in our business, we put obviously capital improvements into it. It could be in the millions of dollars that we're throwing in. What do you typically spend on an oil well to get it up and running?
So much of it is about depth. So I mean, a shallow well, it could be as cheap as a few $1,000s. A deep well, it could be as much as a couple $100,000. So we're always pursuing things between like 3,000 and 6,000 feet, where it's in the low 5-figure range for improvements. You start getting the wells that are 8, 9, 10,000 feet. You're adding a digit to it. So a lot of times after they're played out, they don't make any more or any less than the wells half their depth. So, we don't tend to pursue too deep of wells when it's just a deferred maintenance kind of play that we're
Got it.
chasing, because you're going to get the same end result, but you're going to spend a lot less doing it if it's in that 3,000 to 6,000 foot range on depth.
How have prices going up impacted your guys' business?
Honestly, it's helped on the bottom line for everything we've got done so far, but uh, because it was so low for so long, so much of the labor market has moved to other industries, and everyone's fighting to use these limited amount of services. So it's created some delays, and you've just had to kind of bear it, maybe get a little bit more competitive and pay a little bit more for services. A lot of vendors have taken advantage of the shortage and raised their rates. But really, the way we've just kind of stepped all the way around it is we've looked around for areas that this wasn't the case, which kind of speaks to the area because their service side didn't take as big of a hit. So you know, um, that means the wells were profitable when prices were low.
Sure.
And now that prices are high, it's even better. But we've made our new home Kansas. Now we still have quite a bit of operations in Texas, Louisiana, and Oklahoma. But Kansas, I mean, we've it's hard to quote exactly, but we've moved into the upper ranks in the state all inside of this year because we can get so much done out there. It's such a hospitable state is for operators. We're bringing talent from Texas, the Mecca, to a state that's, very productive, but it's as many individuals that are drilling and operating these wells as it is companies. And nobody's stepping on toes. Everybody's happy to help. They're like, ooh, new Texas money's coming in town. And what can I do for you? We're in Texas. Hey, we're booked. We're busy. Get on the list,
Yeah.
So it's made it really hard for everybody. That's why prices have stayed up for so long. Because you don't just snap your finger and turn on a bunch of new production, because the help's not there.
Yeah.
If a company's got 10 rigs, 4 of them are crude. Company's got 20 rigs, 8 of them are crude. The others are collecting dust and rusting out, because there's not enough help.
Yeah.
It's the craziest things you'll
I mean,
talk to people.
this is every industry. It's great. It's terrible. It's like people are just fly by night way more than they used to be, and they're difficult to land, right? So
Right.
it's
Well, they want to work from home. They don't want to break their back in
yeah,
the
yeah, exactly. Yep.
turning ridges when they can sit at home and work on their
It's
laptop.
like our maintenance guys. It's like a lost art to try to find those guys. They're super elusive. They're difficult to keep around or find any decent help on that side. So
Yeah.
Grant, man, what a great conversation. I really I see so many parallels to this industry and the stuff that you're doing in ours, which is really cool to dive into today. People want to
Yeah.
get a hold of you or reach out. How can they reach you?
Man, my website, you got a contact us page. I've got all the social media channels. I feel like I've uh, got one of the better Instagrams for this industry. There might be a few that are a little bit bigger, but they might not be on hands-on doing it themselves. Probably a lot of bot followers, but no, we're actually out there doing it, and we put a lot of content out so you can kind of see what the stuff looks like firsthand. But yeah, website, social media, that's the easiest
Cool.
way.
Awesome. Well, Grant, thanks so much for being on this show. We really appreciate it.
Yeah, man. Thanks for having me. Had a great time.